this dynamic is true, then what should we do, or how should investors position? Right.
Right. And I think so. I'm glad we got there. So I think that's interesting. But I think actually there's a much bigger story behind this, which is that because of the way media has started to influence investing, right? Started with Reg FD and it's just gotten worse and worse, or better and better, depending on your perspective, right? Where everybody knows everything all the time. What that means is larger companies are always going to have more focus, whether that's research, data, news, whatever, and smaller companies are going to find it harder and harder to break through. And this is just another version of these inequalities in the economy we're seeing over and over and over again.
So differential attention.
Yeah. So the reason we talk about FANG stocks is not because it rhymes and it's cute. It's because you can go through almost anybody's model: ESG, smart beta, tech, trend following, thematic, and you'll find the same 50 stocks in almost all of them. Now, some of them get splintered off, like, the energy stocks don't end up in the ESG stuff, but boy, it's incestuous and that stuff overlaps. And that's not because it's wrong. It's because the way we think about investing is now permeated by this sort of information frequency culture. And so we created this bizarre thing where stock 504 in the cap spectrum doesn't have a pathway to get the same attention, except doing it the old-fashioned hard way of running a better business, earning more money, and having their fundamentals show up on somebody's screen, right?
So this information is, I just want to understand, we're talking about 500 stocks in the market. The ones with smaller market cap have less resources in order to get the attention that they need. You're talking about attention on who's coming to their quarterly calls,
Twitter,
who's writing a report on them. Okay,
yeah.
I just wanted to separate actual research being disseminated to these allocators that you mentioned versus just simple zeitgeist. It's in the Twitter sphere, it's in the zeitgeist. Everybody in the planet's reading or hearing more about these larger stocks, and therefore at the margin, they're getting more of a bid than the other lower cap stocks.
Right.
Yep. Okay.
Well, and to loop this back to some of where Corey was headed in his paper, and back to the point of if we assume that some version of this is true about the markets, what does it mean for how we invest, how we tell our clients to invest? Let's focus on that, because we're not going to pass laws banning indexing, right? I mean, that's ridiculous. So what does it mean? I think it means that we are in this period of heightened volatility. And that's part of why I love the fact people are trying to talk about this in terms of convexity, because what it means is the steady state market, whatever we're thinking it is actually the most fragile state of the market, not the sort of lowest entropy state, right? It's actually the highest entropy state. It's the place you're most likely to get tipped off. And so if you accept that, then what that means is low volatility would be the time to just lever the hell out of both your puts and your calls, right? You just create that smile and accept the fact that if the market goes like this, I'm going to lose 2%, and I'm fine with that, because that's not the equilibrium state. And so that's part of why I loved Corey's stuff so much. Is part of what recently, oh God, I'm going to get the name of the funds wrong. There were 3 ETFs launched this week that I was just nodding my head about. Corey will type it in chat. I think it's SPY-C for convexity. And it's, two old industry veterans who basically are building products to basically do this and say, look, the equilibrium state is not steady state markets anymore. Let's assume that's the disequilibrium state and put all of our extra energy in making sure we make money on the tails, which I think is a really interesting.
It's been interesting this last week how NASDAQ lost 10% faster than its history. It was 4 days of massive losses.
Simplified
by, of course.
Yeah. Well, whole separate conversation about volatility equaling speed, which, I think is a really interesting way of thinking about it, which somebody on your show has said recently, that idea that we haven't actually increased volatility, all we've done is shorten time. That feels much truer to me than anything. There was a great NPR story 10 years ago on auditory, making the sound of trading audible. And when you do that, you can literally hear how the market's changed, which I think is really interesting.
Oh, that's neat. Yeah, I got to look into that. So, yeah.
Sorry, I'm rambling now.
Can I say ticker symbols here in the podcast so that
as long as they're not mine?
I didn't give you advice. I'm just going to say some stuff.
You can say whatever you want, but not ours.
SPYC, SPUC, and SPD, whatever they are.
Right. So it's SPY convexity, SPY up convexity, SPY down convexity, right? One.
So what are the underlying mechanics? Are you familiar with them yet? Or you haven't had a chance to dig in?
I believe what it is just getting beta exposure to start with. I don't know whether they're buying IVV or whether they're doing that by buying all the stocks. My guess is they just launched, they're buying IVV or VU. And then they're just, using using options to basically profit from being wrong on the downside and profit from being wrong on the upside, right? So you're effectively taking the dividend yield of the S&P 500, which is 2% headed to zero, and then using that to fund options on either side.
And you're just buying more straddles as Vega compresses because you can spend the same dollar amount but buy more units. As Vega compresses and vice versa, and try to preserve that.
Further proof, the only class any MBA should take is options and just move on. Because if you can not because you should all be trading options, because once you understand all your Greeks, everything else just falls into place.
Yeah, you're able to price everything else more appropriately. Yeah.